Now, let's shift gears and talk about dollar cost averaging, called DCA. If lump sum investing is like diving headfirst into the pool, then DCA is more like going in gradually, getting comfortable with the temperature and the surroundings as you go. With DCA, you don't invest your entire cash all at once. Instead, you divide it into smaller chunks and invest those chunks at regular intervals. This could be weekly, monthly, quarterly, or whatever schedule you choose. The key is to be consistent. This is very important. The moment you start thinking that the market will go down a bit more and you might wait another week to catch those lower prices, you're getting into market timing. And if you are good at that and investing in individual companies after doing a lot of analysis, then that's fine, I have nothing against it. But then probably you wouldn't be watching a video about dollar cost averaging in the first place, right? So by you being here, I assume you don't want to try to time the market, so don't do it. Set a schedule, mark it on your calendar, block out the noise, and when the time comes, invest it without hesitation. So, what's the appeal of DCA? Well, the primary benefit is risk reduction. By investing gradually, you're less likely to buy all your shares at a market peak. Instead, you're buying at different price points, which means you're averaging out your cost per share over time. This is especially valuable in volatile markets where prices can fluctuate significantly. DCA can also be a good strategy for those who are more risk-averse or who experience anxiety about investing a large sum all at once. Spreading out your investments can make the process feel more manageable and less intimidating. It's like taking small, steady steps instead of one giant leap. Usually people would say that it helps minimize regret compared to lump sum investing, but honestly, I'm not so sure about that. If the market goes up significantly, then you'll regret not putting it all in 6 months ago, as you would have done with lump sum investing. But if you do lump sum investing and it goes down, then you'll regret not spreading it out. So again, a lot of other investors talk about the DCA strategy minimizing regret, but I think both of them have potential regret as an outcome, and it simply depends on the market direction, as I said in the beginning of the video. Now, just like any strategy, dollar cost averaging has its drawbacks. One downside is the potential for lower returns if the market consistently rises. As I said, if you had invested your entire lump sum at the beginning, you would have benefited from the full extent of the market's growth. With DCA, some of your money might be sitting on the sidelines while the market climbs. Another potential challenge with DCA, which is entirely psychological and up to you, is the need for discipline. To reap the benefits of this strategy, you need to stick to your schedule even when the market is turbulent. It can be tempting to pause your investments during a downturn because you think markets will drop more, but that's precisely when DCA can be most effective. So DCA might not be the most exciting strategy, but it can be a reliable and less stressful way to invest, especially for those who are new to the market or who have a lower risk tolerance. It's a slower and steadier approach that aims to balance risk and reward over the long term. This is just a part of my video about dollar cost averaging versus lump sum investing. To check the full version, click on the video that should have appeared on your screen right now.